Good evening, everyone. Good evening, and welcome to this evening's presentation. My name is Adam from Trade with Precision. The first thing I would like to do is a sound check. Just make sure that you can hear me loud and clear. So I recognize a few names. Good to see you regulars returning. And also just a sound check, make sure that you can hear me. So if you could just type into the questions box and just let me know, that would be great. Thank you very much. So welcome to this evening's topic. In the meantime, bad news equals sell, good news equals buy, and how to react to news announcements, which let's just be clear here, that is not how to trade news announcements, it's how to react to news announcements. So the first thing we have to do is we've got two disclaimers. Thank you very much for that, confirming you can hear me. We have a couple of disclaimers to go through, and while I'm giving you an opportunity to read that, I'll tell you a little bit about myself. So I'm one of the traders with Trade with Precision. I'm based in London. I'm a fund trader, and I'm also a swing trader, which really means that most of my trades are placed on the daily or 4-hourly timeframes. In other words, the higher timeframes. It's just a personal choice. It's what I'm doing at the moment, and it's really because there is less volatility there at the moment. And also, I think another thing worthwhile mentioning is I only trade with the trend, and I trade as many markets as possible. So I'm not just trading currencies, I'm trading indices or commodities. And really this is because some markets are not always trending, and I'm always looking for trending conditions. So we're going to be covering some of the approaches that we use at Trade with Precision and that I've applied in my personal trading. So it should all correlate. And I would love for this to be as interactive as possible. So please feel free to ask questions as we go. I would really, by the top of the hour, like to have you get a more practical sense of trading. So I have a question as well. I just want to get a sense of the room. How many of you are in your first 6 months of trading versus how many of you maybe in your first couple of years? And this webinar, of course, is suitable to ideally beginner traders, but also to those who are struggling maybe to achieve consistency in their trading. We're going to be focusing on technical analytical trading, and that's very important to emphasize that we're focusing on purely technical analysis here. And we're really going to discuss how events or fundamental events impact it. So on the agenda this evening, we've got obviously what is good news when it comes to the market, how do we define bad news when it comes to the market, a look at how the markets have reacted to good and bad news in the past, and what we can learn from this, as well as understanding the link between news and market sentiment, as well as the so-called invisible hands behind the news, and really a lot of that just being awful. So we'll kick off and go. We're going to be spending a lot of time on the platform as well, and excuse me, and focusing on the technicals. So what I'm going to do is switch over to the MT4 platform and have a look at the markets as they are currently. So I've just got a number of tabs here. They're not significant. It's really just because I keep creating a fresh tab for each webinar and then kind of filling it up and having a look at those conditions. And so what I'm going to do here is just give you a sense of what I'm doing as well. Is I'm going to start off by having a look at things on the weekly time frame. And the reason I'm doing that is sometimes at the start of our trading journey, we do not appreciate how the monthly or weekly timeframes can be of benefit to us, or how they impact our, even if we're trading a 15-minute time frame, for example, the higher timeframes are obviously of great benefit to us. So we do need to have a respect for that. It's not even impossible that, for example, the monthly time frame could obviously impact taking a trade on the 15-minute time frame. It's really about price levels, and it's easier for traders to identify these price levels when we have a look at the higher time frames. So let's just go back a little bit and talk about how the market, remember that the markets have been here in some shape or form for hundreds of years. The Dow Jones was started operating in 1896, and that was just an index on top of, to correlate a whole series of stocks listed with the Dow. And so a lot of them have been around for decades and decades, and there's always some, for the most part, it's human behavior, but there obviously on occasion, there's going to be a world war, or there's going to be a market crash, or there'll be something. All right, so currently the issues in the news are trade wars or trade disputes, predominantly aggravated by Donald Trump, as well as Brexit, which again also is predominantly almost imposed upon us by the incumbent government. I almost said incompetent government. I mean to say incumbent government. And it has sort of just created almost nothing but chaos and a very good distraction from general kind of economic growth or economic stability in the way. So it's just, we live in interesting times. I mean, anyway, so the point being is that there's almost always something. If you look back over the past, you'll find every decade there's something that's impacting the markets or that the markets are stressing about. And it's also a human nature to not kind of, we're always kind of looking out for or focusing on or gossiping about what the kind of, what are the concerns of the day. And there are very small periods in between where the markets or life seems to just tick over without obsessing about anything too much. But it does seem as though we tend to create our own problems. And it's really worthwhile appreciating that this has happened for it, that there just always is going to be something. And a really great example of that is gold. So I've been monitoring gold for going back to 2017 and basically waiting for this to break out. So this is predominantly a bullish breakout pattern. Okay, so we can't really see this on higher than a monthly time frame, but if you could see it, if you could look at a yearly chart or a quarterly chart, what you'd actually see is you'll notice how the price moves away and then kind of comes back, extends and retraces, extends and retraces, extends and retraces. If you could look on a much higher time frame, you would see that this is one big extension and one big retracement, and it's beginning its next extension now. So my expectation for the time being is to see gold continue to sort of behave in this fashion from this point onwards. We've been below this level since 2013, and this is a bullish breakout pattern. So we were talking about this from 2017. The expectation that I had was somewhere between 2019, somewhere from about this area to the end here somewhere was where I was expecting a breakout. We had the breakout. And at the time, when I was talking about it, the question was, what would cause the breakout? Because we often think that there'll be something that causes it. Will it be a war? Will it be some kind of something that would cause that to trigger? And this is something that we can often look at. For example, let's say that we switch the chart over and go and have a look at cable. So what I'm going to do here is just go look at the pound against the US dollar. Go again to the monthly time frame. Let's just zoom in a little bit and get a sense of what this is. So we don't have all the history here at this time, but the last time we were actually this low was going back in 1983, somewhere around 1983. And so the question I guess we could ask, similar to gold, is that if price had to break through here, what would be the news that would trigger us to go below this kind of level where price is desperately trying to hold above that? The next thing that we need to keep in mind, and I'm sort of throwing a whole lot of different things here, is actually, can I do a very quick survey? How many of you, where in the world are you all listening from? How many of you are outside the UK? How many of you are in Europe versus other parts of the world? So if you could just give me some feedback on that, I'll explain why I'm asking the question. It really has to do with how we are biased in terms of our analysis. Okay, so we've got, so Stephen, you're in the UK, cool. Everybody else is being a little bit quiet. All right, so usually from experience, not everyone is based out of the UK with these webinars, where somebody's in the US, somebody might even be in Australia or Singapore. Excuse me. Now, we tend to be very biased without even realizing it. When we're based in the UK, we often think that whatever moves the pound does must be to do with the news of the day. So it's either to do with politics or to do with something the UK has done. So currently, or at least for the last 3 years, because we've now passed that 3-year mark, we've been involved. The Brexit referendum was held more than 3 years ago, which is just goes to show how ridiculous this whole clown show is. So nowadays, when the pound moves heavily, we automatically attribute it to Brexit or to something, towards something going on with our current incumbent government. And what we often forget is that if we were looking at other charts as well, looking at the euro against the dollar or the Australian dollar against the US dollar, we might have seen a similar big movement at the same time. And that often means that actually it wasn't really the pound that was moving, it was more the US dollar that was moving. So with currencies, for example, which is something that's followed a lot today, we need to be aware that there's two parties involved. And sometimes a market move happens because of the other currency and not strictly speaking because of ours. So that's an important thing to keep in mind, which is one of the reasons I always make sure that if there is a big move in the market that I can't really find an explanation for, that I will look at the kind of other pairs of currencies. So in other words, if it's GBP, I might look at the GBP charts, pound Aussie, pound Kiwi, pound yen. And if there's no similar move across those, and yet I find there is a big move at the same time on euro dollar or pound dollar or Aussie dollar, for example, then I can at least eliminate what might have caused it. And this is kind of important because we're always looking for meaning. This is where I'm going with all of this. We're always looking for meaning in our trading. And actually, the kind of hard pill to swallow, sort of mentally, is that trading isn't about meaning, right? We're not saving lives here. We're trading to make money in the markets. We don't actually need to necessarily know what has caused the move in the market. And technically, this is why technical analysis is so powerful, is that technical analysis over time and again, has shown to largely predict the direction in which the market's going to go, which is interesting because a news event will come out that will sometimes contradict the market move or sometimes agree with it. And usually it'll happen at a key price level. And it's almost as though it's a foregone conclusion. Okay, so let me give you another example of what happens regularly. The price, and this is what's beautiful about technical analysis. Technical analysis is generally about identifying any particular market. So it doesn't matter what we're looking to trade. It's about identifying these key price levels. And these key price levels are significant to the market. Okay, when you and I get in, start trading today for the very first time, we don't really understand the significance, but the market clearly has predefined price levels that are significant. And if we compare it to, say, stocks, so let's say we're talking about Apple, we're talking about some kind of a stock that we wanted to buy shares in, going the old-fashioned route, price would be a factor. We'd want to know, okay, well, it's at 140 or it's at 140 or 1,400. The price would be relevant to us. And it's the same actually with every single other asset class, all right? Whether it's a commodity or a currency, the price level is significant to the, effectively to the biggest buyers and sellers who participate in that market. So these levels are very important. And basically once the market is, usually once it's broken through a level, it will continue down to the next level. And the bigger fish or the bigger money will generally trade it in that direction. And this is where it gets really interesting. The big money and the big whales will tend to have a lot of orders placed at these key levels. Okay, they'll have a lot of orders placed at these key levels. Why? Because, well, that's where the other big fish will tend to operate. So a lot of transactions occur at these key levels. All right. In other words, if you need to, I mean, I've encountered this when I worked in the city. We were trying to get 10 million filled during the news. And it was really hard to get it filled because the spreads had widened, there was slippage, and we were struggling to actually get 10 million filled. So usually what would happen is that the bigger institutions who are wanting to get $100 million of orders or worth of orders filled would tend to do the transactions at the key levels because that's where the other big fish will do their transactions, and therefore there's greater liquidity at these key levels. So that's very important. We need to be aware that we still have price levels that are driving the markets. Okay, price levels that are driving the markets, and they tend to be pushed around by supply and demand. So in this particular case, price is going nowhere. Ultimately, it tries to go out of that range. This is a range over here, and decides it doesn't want to go that way, ends up going lower. Right, it's now stuck technically within this range, and actually looking as though the possibility is that we're going to break to all-time lows, or at least lows that haven't occurred since 1983. We could turn around here, it's not impossible, but it's also just as likely that if we break through this, we're actually going to see the pound weaken tremendously. It's going to go down to, it'll head down towards 1.2 and then 1.1, and it's actually been as low as 1.05 against the US dollar. So we could see that happen. It wouldn't surprise me. The US dollar is pushing for its own thing, and the UK is not looking super strong at the moment. It's frustrating, of course, but it is, and there might be a time 5 years from now when it's recovered. So, you can recover very quickly. So the point of all this is to try to give you a sense of the mechanics that drive the market. There are so many big cogs in it that the news is effectively a few parts of the whole, right? It isn't the main driving force, and this is something that tends to trap newer traders. The one thing that will drive the movement of prices month over month, or at least year over year, will be the difference in interest rates between the two currencies. That's generally going to be where the really, really big money is trying to do its transactions. Insurance companies or big institutions, banks trying to earn a bit of money off the interest rate differentials. Okay, so and so that will generally move it on a at least on a much higher time frame. Then as we come down to say a weekly time frame or a monthly time frame, there might be a particular concern that might be agitating the markets. And then even on a weekly or daily concern, there might be almost concentration points of those themes that are agitating the markets. And then on any given day, we might find that there is either a particular news announcement that, for example, maybe there's a concern about is the economy weakening or strengthening, and then during those periods, right now in the UK, we're much more obsessed about Brexit than we are really about the economy, although it's supposedly connected. Before Brexit came up, all we were really worried about was, is the economy okay? Are we going to have another 2008 kind of financial crisis? Are we stable? Whereas now most of the focus is more about Brexit than it is about the kind of just the general economy. And during those periods, we tend to obsess more about the economic calendar news that is more economically oriented. So then, for example, the GDP or any interest rates, those are the things that will cause the biggest movements in the market, because that's the stuff that the market is most sensitive about at that time. When the economy is doing really well and it's booming, which hasn't happened or doesn't feel like it's happened in ages, then we will find that something different happens. What often happens then is when life seems good and we're making hay where the sun shines, which would be sort of 2002 to 2006, 2007. Often what happens in those situations is that the market tends to ignore the bad news and tends to favor the good news, because it's kind of like there's nothing bad can happen. Whereas since then, we've been highly sensitive to news that doesn't seem to indicate that there's going to be any light at the end of the tunnel, that things might be improving. And so we're often finding that how the market reacts to the news is a combination of the expectation. So if economists are, or the general big fish are expecting a particular number, and the number comes out outside of a sort of standard deviation, then the market will have a reaction. So even if we had the exact numbers, we still couldn't predict how the market will react to this. And this is a very important factor when you're a technical trader. Even if you have a gut instinct that, for example, non-farm payroll, which is a good indication of how much growth is happening in the US markets, which impacts the rest of the world, because we also need to be aware, for those of you that I haven't mentioned this before, we need to be aware that the US economy is the biggest in the world. The GDP sitting at 19 trillion, and China sort of the next closest at 13 trillion. The UK sitting really low down at 2.7 trillion. We're still in the top 10, but it's not that big. So we need to be aware that the US economy can impact everybody else around the world. It's just that big. And so we do need to be aware of how those things can potentially impact us. So US news could, for example, weaken the pound or strengthen the pound, depending on how it happens. But also, not only that, but also professional traders who are technical traders will become aware when the market is overextended, for example. So there's just so many different cogs in play here. When the market becomes really overextended and it approaches a key level, a key historical level, and perhaps there's some high impact news coming out, often traders will potentially unwind all their positions. And so we'll actually see the market react against the news. We might be expecting the market to increase further or to climb further, and instead we get the alternative, and often that would be traders potentially unwinding their positions or triggering a counter trend position. Maybe they're expecting to sell stuff, and so we could see the market do a counterintuitive move. Okay, so for example, looking at the equity markets, let's go back to the Dow. Let's have a look at it here. We can see that it's really worthwhile noting I'm just gonna remove this quickly. It's really worthwhile noting that this candlestick here is when Trump was announced that he'd won the election, that he was going to be president. This period prior to that was the election, sort of the presidential campaign, and prior to that is Obama. Okay, so Obama had a lot of growth in the market, then the market sort of consolidated, goes sideways. A new president is announced, and the market just booms. The thing is that at that point, the market then becomes really overextended. Like if the average of prices here, so let me show you. I'm just going to throw in a 20 moving average. Sorry, so it's indicators, trend, moving average, and just throw in 20. This will give you an average of price. Okay, so if this is the average, this is value. In other words, if we accept this as value, we can see that when price strays too far away from the 20 moving average, that it becomes effectively overpriced. It's overextended. It's got to come back. There's just too many, there's not enough there's no more buyers above that, because basically everyone has bought all they can afford to buy and there's no more there. And now they're either looking to take profit or get out. So this is a great example of what the housing market prices would have looked like before they started to come back down, when everyone was convinced. If you haven't seen The Big Short, by the way, just do yourself a favor. I probably watched it about 10 times now. It's such a great film. And I remember now how the market prices were out of control, and then how they just started dropping, and there just weren't people buying, but the people who were selling were still convinced that they could keep prices high. And so for 6-7 months, the prices still kept climbing, but the sales were just dropping. And so that was a really good time. The point is that ultimately the market then reacted against that. So the point of this line of thinking is that the market has its own sort of supply versus demand, and it has those cycles that are going through it. And again, here what we have is we have a very, very big move in the equity markets, and the market, we knew when it was climbing that eventually it was going to have to correct. We can now see that actually it has it's been going for a very long time, and it's had a lot of growth, and we haven't really come back to test these levels. So in a way we could argue, and again, as I said, these things happen over and over again throughout time, and they'll do it into the future, 10, 20, 30 years into the future. We will find the market becomes too overextended from the moving averages, and it has to correct. All right, it's overextended, it's got to correct, and there'll be some reason why the markets in the news will do the correction. And the theme of this one in particular has been trade wars. Trump announced his trade wars at this point, and this is all we've really been dealing with for almost 2 years. The trade wars they're still going on. So the trade disputes and all the tensions still going on, and there is our consolidation. So the market reacts. What's to take away from this is that the market reacts in basically the same way, but to different kinds of news. So in other words, uncertainty causes the market to consolidate. The market is very overextended here, which is why the volatility is so much greater here, because effectively it gets magnified as we go higher and higher and higher. If we go look at gold, if you go right back to these periods of time, right back to the beginning, and this is only 2000, there's very little growth here by comparison to what we had in the last part of 2010 and 2011. It's almost as though it goes exponential. And it's the same with these markets. We're seeing that they're relatively speaking, this volatility here is in proportion to the growth we've had. It might not seem like it, but it is, especially when you look back over the last 100 years, for example. You'll see that as it moves further and further and further away from zero, the corrections are bigger and bigger and bigger. So basically the moves are big, the corrections are bigger. So again, the key thing is the market is always going to react to uncertainty the same kind of way. And what's interesting about this is again, I was talking about all these different cogs that are in the marketplace. All right, so you've got a lot of people who've been making money during this period, and they're very keen to keep making money. So they've got cash. Because if you recall, after the 2008, a lot of companies got rid of employees. They stripped right down. So all of a sudden, each employee is doing the work of 3 or 4 employees, and so on and so forth. Suddenly, they become cash rich, and they've been investing in these markets. So a lot of companies actually have made cash, not necessarily individuals, but companies have done quite well, and they're really big in terms of investing in that. And so they have buy orders sitting at these key levels. Okay, so they will have buy orders sitting here. As far as they're concerned, they have the cash and they can think about it in a 5-year or 10-year cycle. And all they really do is tell their brokers, or they do it themselves, depending on what kind of institution they are, to have buy orders sitting at these key levels. And if the market comes down there, great, they can buy it at a discount. If it comes down there, they can buy it at a discount. So you'll often see that the market will bounce off these levels because it triggers the buy orders. Now, one of two things happen. Either there's enough buyers there to shift the tide back up, all right, but there's not enough buyers above here. There's just not enough buyers above here. Everyone's a bit skittish, so people are probably taking profit share and stepping out. It's kind of one of those things where they have to see the market head over, then other people jump in, and then it takes off. Right now, there's just not enough buyers above that level, and there's not enough sellers below this level at this point in time. So the market will come down. Let's say it comes down to this level, bounces again, but this time there's fewer people buying. Maybe the people who were scared or who weren't scared this time are now a little bit more jittery. So the market comes back down to the level, and then eventually it breaks through the level. And at this point, there's just more bears in this area, or more sellers, or fewer buyers, and eventually it comes down to here. So they'll get to a point where there's, it's discounted enough that people will start getting back in, and maybe at the same time the media doesn't sound as bad. But we often try to, and this is the thing that often destroys people who try to learn how to trade, is they are forever. And this is really the point of this webinar this evening, is we really should not try to reconcile why the market does what it does when we listen to the news. Because although the news in general might be adding a flavor of emotion to the market, the market is made up of so many more pieces and cogs and moving parts than just the news. So Trump might tweet something and there's a bit of a reaction to it, or there's a reaction in the market, there's a move in the market, and people look and see if Trump's made a tweet, and then he has, and they attribute it to that. So often, I've seen it, people are often looking for something to explain the move in the market. And sometimes it could be as simple as a trader or a big institution got out of a position or got into a position, and that created a bit of a bounce. So there are, again, something we do need to keep in mind. So let's just go back to the list. I just want to go back up and have a look at this agenda. So good news is generally when the market is anticipating positive news, and when the news comes out, the market continues in the direction it's expected to, which would mean in the case of equities that, for example, or oil or commodities, that prices would go up. So on the good news, it's anticipated, it comes out, and the market goes up. Right, bad news is the same thing. The market's anticipating negative results, and when the news comes out, and it is what it is, the market then responds to that. And that's almost a bit more orderly. That's what we would expect. We'd expect when the market hears good news to go up, and when it hears bad news to come down. What we're finding at the moment is we're a bit out of sync with stuff. We're finding that when, when good news comes up, the market reacts negatively, and when it's bad news, the market reacts positively. And this will always happen. We have it we have it especially when we are going through stressful periods. It happens that when the market responds the way we would expect it to, it's generally when like that period I mentioned, 2002 to 2006 or whatever, when there's really good growth, everybody seems to be having, everything seems to be going well. That's when the news and the behavior between the markets and the news tends to correlate. Currently, though, the market is reacting differently, because actually what's happening is people are looking for just opportunities to get out of the markets or get back in. And so bad news would cause the market to climb. If, for example, bad news would cause the market to drop, and then people can buy at a discount, then they would get in and the market would climb. So in other words, the market climbs because people want the bad news so that they can buy at a discount. So that's very interesting to see how that happens. And we can also see how the markets have reacted to good and bad news in the past, what we can learn from this, but it's historically the same. The behavior we're seeing now is actually exactly the same as it's been after 2008. What we really haven't had is just and depending on your age or how well you remember it, but basically the last 10 years has been pretty much of a muchness. The markets have just generally been unpredictable. Although we've seen the equity markets climb out of the US, when we look at other markets, the growth hasn't necessarily been there. But the point being is that most of the markets don't seem to have really decided on what they're going to do, and certainly the mood out there doesn't seem to be clear. Even over the last couple of years where the market has been booming, I would say 2010 to 2017, the media and the markets were still incredibly negative, which is amazing. So the markets were just booming and no one was interested in that. So really, when we talk about understanding the link between the news and market sentiment, we do need to be aware, sure, what are the key issues that are generally out there, but it really helps to think in terms of big concepts like Brexit certainly would create uncertainty, and the trade issues would create uncertainty. Of course they would. And that alone would be enough to give us a sense of that. But also, for technical traders, we'll always examine what are the actual conditions. So let's imagine I had a pet monkey, or let's say, for example, that I had a time machine. I could go back and teach myself how to trade. And what I did was I said to myself, listen, I don't want you to look at the news, or I want you to trade effectively without listening to the news at all. And I would be able to do that. What would happen as a technical trader is that I would look at the conditions, all right? So I would look at certain conditions and go, okay, these conditions are not that stormy. The analogy that I often use, I'm going to repeat it here, but the analogy that I often use is surfing. I always talk about how if you wanted to surf or learn how to surf, you know, you'd be looking for certain conditions that you would go outside in, and you certainly wouldn't go surfing if the water was incredibly stormy and choppy, where it's too dangerous. You also wouldn't go out when the ocean surfaces were so flat that there was just nothing happening. So you'd be looking for a range of conditions, certainly where you could see the sets of waves coming in, and a range of conditions where you could do what you want to do. You could surf, but also it's not going to destroy you. And those conditions obviously are that would then be acceptable. So it's the same actually when it comes to traders. Traders have a range of conditions where they would still consider taking a trade, and they'd be looking for those conditions. And what I just sort of pointed out to you there was those conditions there. Some of those conditions are much more acceptable than the other conditions. So for example, here there's a relatively decent trend, and also if we go back here, it becomes like it is now incredibly volatile. Okay, it's just the market doesn't really know what it wants to do, and it's still trying to figure out what it really wants to do. So these types of conditions from a technical perspective do make life a little bit more difficult for traders. They do make it a little bit more difficult, at least in terms of technical trading. And professional traders would actually just opt out of trading those market conditions. Basically, they would just not get involved. They would just effectively, or they would switch over to just buying en masse at a particular price. But certainly they would not be feeling that the market conditions are friendly at all. And this is an important thing. So one of the mistakes, again, that beginner traders make is maybe they feel that they should be trading a particular market. They feel they should be trading the news. The reality is that the most successful traders are looking for conditions that are as predictable and as safe as possible. So they'll be preferring when the market goes from within a range, maybe it's within a range, breaks out the range, and now it starts behaving in a much more orderly fashion, becomes a little bit more predictable and therefore a lot safer. So these are the kind of conditions we want to be seeing. And if we look at the market right now, we're not seeing those conditions. It's just that simple. So technical traders would just simply not be looking for that. Or on the other hand, if we went down to lower time frames, so let's go and have a look at a much lower time frame. Here you can see there is very much a trend in place. We'd have to identify these key levels. But again, this is on say a 1 hour time frame. Then they are much shorter term positions and much more aggressive with their trading. And all that does is if all the professionals are behaving that way, it makes the market a lot more choppy and unsettled. And the market is going to be this way until effectively the media starts to calm down. So it's either going to decide that it wants to do a bigger correction, so on a monthly basis. Does the market want to come back down to here, for example? But right now it's looking pretty bullish. Okay, it's looking pretty bullish at the moment. If you look at that particular candlestick, you can see that it is still finding some strong level there. It's very keen to go, but at the same time, last month's candlestick just failed to go this way. So we've definitely got some difficulty getting past this level. I would say that if we do finish bullishly this month and the next candle fails to break the high and starts breaking the low, breaks the low before it breaks the high, I think we're in to see another move down towards these lower levels. And that's really just talking about the volatility in the equity markets. So we need to just be aware of that. Now, if we did the same thing with currencies, if we took that same approach with currencies and went and had a look at, say, cable, and we then looked at what are the conditions right now. So the conditions, if we go and have a look and just spread them out a bit, there is actually a bit of a trend. We're also sitting at a key level. Okay, so if we go down to the daily, we can see there's definitely a downtrend in place. All right, it's the swings are a lot sort of more choppy, but there is definitely a direction in play. All right, and also if we look at it from a weekly basis, it actually looks as though it's setting up to go lower. So that's very interesting. That bearish candle here, if we break the low next week, we could find price dropping below that. Let's go and look at another few charts. So let's look at, say, let's look at Aussie dollar, for example. And so really, as I said, the idea here is usually for us to look towards the conditions first and decide. Here we can also see it heading lower. If we throw in Kiwi dollar, we can see it's also heading lower. So again, we can see the pound heading lower, the Aussie dollar heading lower. We've thrown euro, and that's also heading lower. This is generally telling me that the dollar is really strong, and that's the common factor here. It's knocking both the pound and the Australian dollar and Kiwi dollar lower. If we then go and have a look, I want to have a look at some of these commodities. So let's take a look at, say, US oil, for example, or let's see what UK oil, and they'll be roughly correlated. At the moment, you can see we had a very strong, nice uptrend here in the past, and since we had this strong sell-off, we haven't really got a clear direction. The market isn't continuing to trend up, and it's not really trending lower. It's still stuck within this area, and so the market has that uncertainty. And if we want to find a reason for that, so in other words, it's quite interesting because it's almost similar to, I haven't thought this out fully, I'm saying this on the fly, so I need to think about it. But for some people, they might argue that religion is a way of finding meaning in our lives, for example. And these days, people tend to find meaning in things and not so much in other stuff. And maybe that's what it is with trading, is looking to the news to find meaning, rather than just, understanding that the market is always going to do what it does. It's always going to be choppy. It's going to be spiky. And so what we do as trend traders is we focus, first of all, on the things that we can control. We do look for conditions that are as favorable as possible. We stay away from charts where the market is incredibly choppy, where there's no clear direction at this point in time. And we then would also want to be aware of the economic calendar news. So what news is coming out that's high impact, that could impact this particular move. The perfect conditions that we have, what we really want is for these perfect conditions to be uninterrupted. So if we find a beautiful trend, we're probably going to be concerned about any news that could come out that could disrupt this perfect trend, and then we'd want to stay away from it. So that's the kind of thing that we would be very, very cautious of, and we would stay away from that. So that's something to be, it's just an interesting way to look at it, whereas most people assume that traders love trading the news. The news is much more akin to gambling than trading, because you don't really have any control over what the outcome is. And so we would have to be very risk averse on that. So if we look at, say, gold, for example, gold's a little bit overextended at the moment. It is also sitting at a key level. Let's go back to gold here. Gold is sitting exactly where it's supposed to be. Here's the next key price level. So that is exactly where it's supposed to be. Most of the traders who are buying would start taking profit at this point, and we don't know yet if it has enough strength to do it. If we go look at it on a weekly basis, we can actually see that it's also overextended. It does need to probably come back and retest this level, and there'll be a lot of buy orders sitting here as well, because most people would like to get in at this price if it does come back down. So a lot of this is regardless of the news. The fact that this broke out, we were discussing this. It's been setting up since long before Trump was president, long before Brexit came up. It was starting to look bullish. And so it's quite interesting that people will put it down as safe haven or various other reasons. And the reality is that it's likely that gold is going to continue to climb, right? And that's because it just will, for whatever reasons. What we do need to pay attention to, or to think clearly, is to understand that it is both more complicated. There are more cogs in play than we think, and also less complicated. The most professional traders will usually either have much more research, teams of researchers, and make an informed but longer term decision on any positions they take. An alternative, and the only other alternative to that, I beg your pardon, is technical traders. And technical traders will use price levels and bullish or bearish behavior to make their decisions. And that's it. They'll hold those positions depending on whether they trade the 1 hour time frame or whether they trade the monthly. These key levels and the general behavior will stay the same. Okay, so when you have a really good daily trend, you will find all your day traders, the people who are trading on the much lower time frames, 15-minute, 5-minute, 1 hour, 4 hour, will all be on the same chart, because statistically we have more winning trades when we trade in the direction of the daily, and especially if the daily is trending. Okay, especially if the daily is trending, we will make a lot more if we trade the 1 hour in the same direction. Okay, so now the fact that the market here is likely to turn on and come back actually makes sense when we look at it from a monthly perspective. It's broken through this resistance, testing the next key level, and it now is in a position to come back and test that level again before continuing back up. So it's kind of a breakthrough and a retest of that level. And also it could continue up. So it might even not go all that way. It might come back a little bit. Maybe it might find that it can hold and come back to that level and continue onwards. And so we'll be looking as traders, we'll be looking for entry opportunities in these areas. Okay, so just going to go back to this. The invisible hands behind the news. Okay, so this is a very interesting topic as well. It's very easy to get into the mindset that the markets are being manipulated. It's not impossible that key people, key politicians or economists who have access to a microphone, it's not completely impossible that they could say things to cause the markets to react a certain way and jack up their pension. It's not outside of the realm of possibility. Generally speaking, though, most of the individuals who are in these roles are generally professional and are not looking to disturb the markets any more than absolutely necessary. Some of the markets are also so big that they are very difficult to be manipulated. Currencies especially are absolutely gargantuan. It's very difficult to manipulate them in terms of that. So, and so that's something we want to be aware of. So we also don't want to get paranoid, because then we start to think that, presidents and these people and economists are moving and manipulating the market, and that creates a bias in us anyway. And so this is one of the hardest lessons to learn. Traders have very big breakthroughs. We go on these journeys. They're called universal experiences. There's almost nothing that I haven't heard another trader say that professional experienced traders can't say. You know what? I remember that I thought the same way, or I had the same experience. Maybe moving my stop loss, revenge trading. These are all basically universal behaviors and experiences that we all go through. And one of those is absolutely being convinced that the market's out to get us, or that we form an opinion. We start to be convinced that the pound is going to crash, and we start selling, and it doesn't. It starts going up, and then we're convinced that it's going to crash again. We keep moving our stop loss, and eventually we do enough damage to our account that we just stop doing that, and we maybe make the same mistake again and again and again. So when I was learning how to trade, which was 2010 through to 2011 and 12, I remember, I think it was 2011, maybe 2010, that one of the trainers who was talking about it, he suggested I subscribe to Nick McDonald's newsletter, which he was, and at the time Nick McDonald was a trader doing technical analysis for the Intercontinental Exchange out of the US. And this he would do 2 3-minute pieces, a 3-minute piece on the US dollar index and the major currencies, and another 3-minute piece, give or take, on the global markets, the global indices. So I started subscribing to it, and he was purely technical. That's it. He said, these are the levels, price action looks bullish. If price breaks through this level or breaks the high of this candle, then I'll be looking to go long, or it's looking bearish. If it breaks the low before it breaks the high, then my expectation is the price will come down to this level. So basically it was price action and key levels, and that was it. And he would do this every week and every week. And I think I followed him for about 2 years. There's a story there anyway, and basically he just called it right every single time. And I remember back then I had a couple of positions where I was going the opposite to what he said. I could see what he was pointing out. He was going, yep, it's bearish. My expectation this week is we'll see this happen and this happen, and it did. And he might have highlighted it. He might have said, look, we've got an election coming up, so I'm not sure how the market's going to react to that, but currently the price action is bullish, that kind of a thing. And the thing is that he was always right. And I learned the hard way that I was still making decisions based on what I heard in the news and not on technical analysis. And so where I am today, and I stopped after that. And when I said there's a story there, is that obviously I ended up working with Nick, and then I ended up taking over those analysis for the ICE commentary. I started producing those, and they were watched by 30,000 people or more. I think 30 to 40,000 people worldwide. And so I learned my lesson from that, which was just let go of the news and kind of focus on the technicals. It doesn't mean that I ignore the news. I read the news. What I don't do is allow that to impact my analysis. If I'm looking at the markets and it's overextended as it is here at a key level and we have a bearish candle forming, this from a technical perspective means that gold is now, it's highly probable it's going to come back down to these key levels. Okay, I don't need the news to tell me why gold might be hitting lower in the next few weeks. I don't need to know why it is. There'll be something that explains it. There's always something that explains it after the fact. And there's also a Latin saying, I love it, it's a Roman one, it's called post hoc ergo propter hoc, which basically means thereafter because of, or something. Basically it means that humans have this habit of, when something happens, we look for an explanation as to why it did, and then we just attribute it to that explanation. And so often if there's a move in the market, we look for a reason to explain it and we just attach it to that. And sometimes we might be right, and lots of times we can be wrong. So it's just something to keep in mind, is that we don't want to burn energy focusing on making decisions around the news at all. We need to be doing it based off evidence. And so what that means is, if in general, here's a good example, gold is in an uptrend, all right, although in the shorter term, it may come back down, it is still within an uptrend, all right? It's in an uptrend on the monthly time frame, high lows, high highs, weekly time frame, high lows, high highs, and daily, it's still producing high lows and high highs. And so it is still in an uptrend. That means that if it comes down to this level on the weekly, I can still look for buying opportunities, even if the news has now turned largely negative, which is what people would be looking for. And they'll start going, well, gold's dropping because of this and this and this. The fact is that right now, especially if price comes back to one of these two key levels and sets up with a really bullish candle. So a really bullish candle would be something of this kind of a shape. If we've got a really nice strong candle there or there, then, or even like this one over here, then I would be happy to look at that as a potential buying opportunity. And that's really about how the technicals are there. We tend to use the technicals to find the evidence to support it, that we, why we take the trade. And so the reality is as well, when we look at buying stocks, for example, we should be looking absolutely at the numbers if we want to go into that kind of detail. But technical traders will take advantage of what the trend is at the moment, and we don't need to overthink it. And the beauty of trading technically, when you don't have to understand why things are doing what they're doing, is it's stress-free by comparison. Okay, we don't sit at night trying to understand why the market's doing what it's doing, in the same way that if we're surfing the ocean and surfing the waves, all right, we just need to know how to swim. We need to know how to get on that board. We need to know how to obviously navigate a wave. We need to know how to identify a set of waves. What we don't need to understand is how waves came to be, and how water formed on the planets, and how the moon and everything, move everything in conjunction. We don't need to understand the bigger stuff to be able to navigate the smaller stuff. And that's very important to take away today, is that we could technically trade conditions without having to understand why they are in the condition they're at. And that's very important. If we get obsessed about why they're in the condition they are, or we start trading for other reasons, we're going to get ourselves into a lot of trouble. And there's just so much evidence to support that. So it's very nice to step out of that and to start committing to technicals. So if I start hearing a lot of positive news about the pound and Brexit and everything, but the pound is still getting weaker, I will still look to short the pound. Okay, I won't start buying the pound until I see an uptrend. Okay, so in other words, my trading decisions are not based unless the technicals are correlating with the news. And that's a very, very important aspect. So let's go through a couple of the others. So we can see gold is really nice and bullish, which is why it sits on my watch list. In terms of the indices, okay, the indices are currently ping-ponging between these levels. If I look at them on a monthly basis, it does still look bullish here, but I still need to see a follow through. We need to get above here. There's just not enough. Price came up to here, pull back just a little bit higher and just a little bit higher. It doesn't seem that there's enough people here to resume this trend. It's a little bit like this. So I want to see how that ultimately turns out. What else have we got here? We've got a couple of other charts. Excuse me. Gold is looking pretty good. How is silver looking? So let's just throw in silver into this and then go and have a look at that. Silver is also in a really nice uptrend. So for me, the best trends right now, and certainly trades that I can stalk, and this is another thing as well, beginner trades might not be aware of, but we stalk our trades. So I'm looking for an entry here. I'm waiting for gold to come back to this level, and then I'll be looking for an entry opportunity into that. So that means that I might take a trade next week or the week after that I've already identified. I've already identified the trend. I've already identified the area where I'm looking to get in. I'll just be waiting for price to produce a nice entry opportunity there. Something like this would be beautiful. Doesn't have to, it could be something small, but I'll be looking for that. So keeping in mind that when we often think the traders are just sort of swimming around like sharks in the ocean waiting for an opportunity and then they see it. No, we've identified gold and silver are good money making opportunities at the moment. I'm looking for an entry into that trend. I've already identified the area. So now I've just got to tailor it. What is the size of my candle? Where do I put my entry? Where do I put my stop loss? And where do I take profit? Okay, so already know again on the gold one, we know where we're going to take profit. We know that if any other trades I take, probably take profit a bit ahead of this if I can get in here. Okay, stop loss below this makes sense. And that is purely technical trading. And again, you know, I don't know what I'm going to be trading 2 years from now, but I do know it will be trending. Okay, whatever I'll be trading in the future will be trending. And therefore, whatever news may come our way, if there's a third world war or something else happens, aliens invade the planet, whatever, as long as the markets are operating, I'll be trading whatever is trending. And I'm pretty sure that at that time we'll be obsessing about something else that has upset the market. If it isn't something particular to our own economy, it might be particular to one of the other trading partners or to a particular commodity or some other kind of crisis. There always seems to be something there. And that's the drama side of humans, that we tend to do that. We do create our own problems for sure. Right, and so that just kind of gives you that sense of what's going on. In terms of the currency markets, certainly everything is very close to key levels. It's definitely worthwhile noting that cable is sitting at a key level, that the euro dollar, bring this in, is also sitting at some key levels. So if I just had to highlight these, in fact, I'll go weekly and just frame this. There's absolutely some key levels over here that I want to be aware of. And there's a few here as well. Okay. So there's a couple that I want to be aware of. If we do find the dollar breaks out, pushing the euro through this level and the pound through its level, we might find that's also the case. Again, if I go through and have a look at, say, the Australian dollar in the same way, and just put that up, go back to that weekly. We're also sitting at key levels here. You can see we've got key levels there and also key levels here. So a lot of these major trading partners or major currencies are sitting at key levels where the US dollar is the one that's pushed them to this, and the US dollar is definitely the big cog right now. And we could see that it ends up heading a little bit low. So from a economics perspective, I was going to say, I was just trying to term it this way, phrase it this way. Absolutely, I would say the biggest issue globally is the trade war, because the US economy is impacting everybody else's economy. Secondary to that would be Brexit, all right, and how the UK, especially more about how our faith in the government's, first of all, the government's introduction of this problem, as well as the subsequent managing of the problem, has reduced our confidence and the confidence in the economy, because we're just not sure when it's going to come right, and it just doesn't seem to, nobody seems to be controlling it. So and so that is a kind of something. Doesn't mean that I won't trade GBP pairs if they're not trending. It just means that I will avoid them, and I won't be too concerned about the news either. The only thing that I'm always cautious of, we are always cautious of, is elections over the weekend. Elections are big because they can change, policies. Interest rate things such as central bank announcements, which is usually once a month, and maybe the US ones, FOMC and non-farm payroll. Those are generally the ones that could shake the markets around, especially if I'm trading on the lower timeframes. If I'm on the daily, for the most part, we can ignore most of that. It doesn't mean the news won't impact us, but it does mean that it's not going to impact us directly. And so on that note, ladies and gents, let's head back to the slides and just carry on with this quickly. If you're not familiar with ATFX, they are regulated by the FCA. There's their license number as well. Very obviously a very easy to use and efficient payment portal. They are obviously committed to providing competitive pricing for their clients, and they've based themselves on the MT4 platform. So there's obviously contact details, which we'll get to in a moment, and they're based in London. Been to the offices, very good folks. If you do have any questions, please don't be afraid to give them a call and ask them to assist you. I am recording this. This is being recorded. I will upload it, so it should be available for you to access at a later time. There we go. Ladies and gents, that brings us to the top of the hour. I do hope you've enjoyed this. I do hope you found it instructive and useful. Absolutely, if you are a technical trader, this would be of value to you. If you're purely interested in the fundamentals, tonight was really about how we navigate the fundamentals using technical analysis. But again, it was an absolute pleasure, and I want to say that thank you very much for your time. What I'm going to do now is end the webinar, which is going to hoof all of us out, and I want to wish you a good evening. And good, I'm glad you enjoyed it. And that's it. I look forward to seeing you in future webinars. So thank you very, very much. Have a good evening.